For decades, retirees have been told that if they withdraw 4% of their retirement savings each year, their money should last for the rest of their lives. It's called the 4% rule. And for many years, it became one of the most popular retirement planning guidelines in America. But does it still work in 2026? The answer is, it's complicated. Today, let's fact check one of the most famous retirement rules ever created. Let's start with the basics. The 4% rule suggests that a retiree can withdraw approximately 4% of their portfolio during the first year of retirement and then adjust future withdrawals for inflation. For example, if you retire with $1 million, the 4% rule suggests withdrawing about $40,000 during your first year of retirement. Simple enough. But there are some important assumptions behind that rule. The 4% rule wasn't designed as a guarantee. It was based on historical market data and assumptions about how retirees invested their money. The research looked at past market performance and asked, would a retiree's portfolio survive over a 30-year retirement? In many historical periods, the answer was yes, but retirees don't live in historical periods. They live in the real world. A lot has changed since the rule became popular. People are living longer, healthcare costs have increased, markets have become more volatile, and inflation can significantly impact purchasing power over time. A retirement lasting 30 years may now need to last 35 or even 40 years for some retirees. That's a very different challenge. The biggest threat to the 4% rule isn't necessarily poor average returns. It's something called sequence of returns risk. Imagine two retirees who earn the exact same average return over 20 years. One experiences market losses early in retirement. The other experiences those losses much later. The retiree who experiences losses early may run out of money much sooner. Timing matters a lot. So does the 4% rule still work? For some retirees, yes. For others, maybe not. The answer depends on your spending needs, your life expectancy, your investment strategy, your other income sources, and your tolerance for risk. The 4% rule can be a useful guideline, but it should not be treated as a guarantee. Today, many retirees use a combination of strategies. Some use flexible withdrawal rates. Some reduce spending during difficult market periods. Some incorporate guaranteed income sources like Social Security, pensions, or annuities. The goal isn't to blindly follow a rule. The goal is creating income that can support your lifestyle throughout retirement. So what's my verdict? Does the 4% rule still work in 2026? My answer is, it depends. The 4% rule remains a useful starting point, but it should never replace a personalized retirement income plan. Retirement is simply too important for one rule to answer every question. The bottom line is this: the 4% rule is one of the most useful retirement concepts ever created, but it's a guideline, not a guarantee. The most successful retirees understand their income needs, manage risk, and remain flexible when conditions change. If you'd like to see more retirement claims fact-check videos covering retirement income, Social Security, annuities, market risk, and retirement planning, subscribe to the annuities.net YouTube channel. And tell me in the comments, do you think the 4% rule still works today? I'd love to hear your perspective. Thanks for watching, and I'll see you in the next fact check.